Hello, I'm Larry Harris. I hold the Fred V. Keenan Chair in Finance at the USC Marshall School of Business. I'm an expert in an area called market microstructure that involves the study of dealers, brokers, traders, exchanges, and everything to do with trading. I used to be Chief Economist of the US Securities and Exchange Commission, where I spent a lot of time working on market structure issues. We're going to talk about payments for order flow. Payments for order flow are payments that certain dealers pay to retail brokers in exchange for having the retail brokers send the dealers their clients' orders to buy or sell. People are concerned about payments for order flow because brokers are responsible for getting the best prices for their clients. And the concern is that perhaps payments for order flow are corrupting the broker's order routing decisions. Payments for order flow have been in the news extensively during this past year. The broker Robinhood obtains very substantial revenues from payments for order flow. Our agenda today is to discuss why dealers make payments to brokers for order flow. We'll explain how the payments affect the brokerage clients, and we'll identify some public policy alternatives that can solve some of the concerns that people have about payments for order flow. To best understand payments for order flow, it's useful to understand first a process called internalization. Payments for order flow do not occur within the internalization process, but if you understand internalization, much easier to understand payments for order flow. We say that a broker-dealer internalizes its clients' trades when the broker-dealer fills the orders for the client, acting as dealer. So if the client wants to buy, the broker-dealer will sell to the client, and what the broker-dealer will sell will come out of the dealer's inventory. When they do this, the dealers always promise to fill the orders at prices no worse than the best prices that the clients could get if the orders were routed to an exchange like the New York Stock Exchange or NASDAQ. Those best prices are called the national best bidder offer, and those are the prices that are displayed as the best prices available at any exchange in the national market system. Now let's talk about order preferencing, in which payments for order flow occur. Dealers who are called wholesale dealers pay brokers to route their marketable orders to them for execution. A marketable order is an order that can be filled immediately. It's an instruction to go out and get the best available price. The routing is called order preferencing. It's called preferencing because the brokers preference the order. That is, they express a preference for sending the order to a particular dealer rather than to the dealer that's offering the best price. The payments are called payments for order flow, and that's what we're talking about today. Now, the dealers always promise to fill the orders at prices no worse than the best prices available at exchanges. Those prices, again, are called the national best bidder offer. They often provide better prices than the best prices at exchanges, and the brokers claim that they insist that the dealers provide better prices to their clients. The payment agreements usually provide about 50 cents per 100 shares to be split between the broker and price improvement for the broker's customers. The broker specifies how much money they want to receive, and that goes directly to the broker's bottom line. And then the remainder of that 50 cents, not always 50 cents, but something around 50, the remainder of that is provided in the form of better prices to the clients. So better prices are lower purchase prices than the best offer for clients who are buying, and better prices are higher bid prices, selling prices for the clients who are selling to the dealers. Now, there's an agency problem involved with both of these processes. It's very easy to see the agency problem with internalization, and with order preferencing too, Once you understand internalization, the agency problem becomes quite clear. An agency problem is what arises when somebody is acting on your behalf, but not doing what you would want them to do. So in this case, the client always wants the best price. The question that we have in front of us is whether the broker is getting the best price for the client. Now, when the broker is internalizing the order, so the broker is filling the client's order, acting as a dealer, trading directly with the client and not on behalf of the client, there's an obvious agency problem because of an obvious conflict of interest. Acting as broker, the broker should try to find the lowest price to fill the customer's buy orders and the highest price for the customer's sell orders. But acting as dealer, trading for the benefit of the dealer's account, the broker-dealer wants to sell at high prices and to buy at low prices, an obvious conflict of interest. Now, when there's preferencing, essentially the same thing happens, but it works a little bit differently. The more price improvement that the broker demands from the wholesale dealer to provide to the broker's customers, the less profit the dealer makes, and the less the dealer is willing to pay to the broker. So while the broker is supposed to be getting the best prices for the client, the more the broker pushes the dealer to provide better prices, the less payment the dealer will provide to the broker's bottom line. So the broker has a conflict of interest, and many people are concerned that brokers don't work hard enough to get the best prices from dealers. They're also concerned that perhaps better prices might be available at exchanges, and I'll explain that in just a few moments. So internalization and preferencing are similar. It's important to recognize this when we think about the public policy alternatives that might solve these problems. They differ only by who owns the dealer operation that fills the orders. With internalization, the broker-dealer is the dealer who fills the orders, so the broker-dealer owns its own dealing operation. With preferencing, the broker-dealer contracts with a wholesale dealer for the dealing services, but now the broker-dealer and the wholesale dealer have a common interest to obtain profits from the customer's orders so that they can divide it among themselves. A little bit about the wholesale dealers. They are high-frequency traders. The names involved, some of them you know well, and others you may not recognize. So Citadel and Virtu are commonly known names. G1 Execution Services, Two Sigma Securities, and Wolverine Securities are other wholesale dealers. Let's now talk about how dealers profit from filling retail orders. That'll help us understand why they're doing this and whether the retail traders are being hurt. The first and most obvious way that dealers profit is they are able to buy at lower bid prices and sell at higher ask prices. They simply buy low and sell high. So when they fill a customer order from a retail broker, the buy orders get filled at higher prices than the sell orders. And the difference between those prices allows them to make money. Now that difference is constrained by the best prices available at the exchanges. Those best prices, again, are called the national best bidder offer. But the national best bidder offer tend to be pretty far apart in the following sense. The dealers who quote to trade at the exchanges are concerned about trading with very well-informed traders. Retail traders tend not to be so informed. The danger of trading occasionally with informed traders is that if you sell to an informed trader, because the informed trader is buying, prices will tend to rise. And when prices rise after you sell, you lose money. And if you buy from an informed trader, when prices tend to be falling, as they do if the informed trader is truly well informed, then you'll end up buying and holding an asset whose value has dropped, and you'll end up losing money. In response to those risks, spreads in environments like exchanges where informed traders occasionally trade, spreads tend to be wider because the dealers need to recover from all traders what they lose to the informed traders. Now, the retail traders, though, are generally much less informed than our institutional traders that often trade at exchanges. And of course, the hedge funds that are typically the best informed traders, they usually will only trade at exchanges because wholesale dealers don't want to trade with those informed traders. So the dealers lose less money to the retail traders than they would if they were trading at exchanges. So if they're able to trade at the wider MBBO prices, they make money when they trade with retail traders because the retail traders really should get better prices. Now, the dealers do offer better prices to the retail customers, but the question in front of us is, are those prices as good as they should be? So price improvement returns some of that profit to the customers. The second reason that dealers profit from filling retail orders is that at exchanges, very frequently, there are orders that are hidden, that is not displayed, at prices that are better than the national best bidder offer. For instance, there may be buyers who are willing to buy at prices better than the displayed best bid at an exchange, or there may be sellers who are willing to sell at prices lower than the best displayed offer. The wholesale dealers, after they do a trade with a retail customer on an order that was routed to them, say the customer wants to buy, the dealer will sell at a price somewhere near the national best bidder offer, and then they will immediately go to the exchange and try to buy back, hoping that they can find a better price at the exchange. When they do, they make an instant profit. And so that's another reason why dealers make money when trading retail order flow, is because they often find hidden liquidity that the brokers are not looking for. A third reason why dealers profit from filling retail order flow is that the dealers learn what the retail traders are doing. There are millions of retail traders, and they respond to only a finite number of signals, pieces of information, news. When some decide to trade, it's very likely that many others will also want to trade, but they don't all trade at once. Some arrive sooner and some arrive later. Dealers who know what trades retail traders have already done can often anticipate the trades that other retail traders will do. This information allows the dealers to profitably trade ahead of orders that are expected but not yet received. If those orders, say they're buy orders, if they push the market up and the dealer has bought in front of those orders, then the dealer will be able to sell at higher prices and make money. So knowing who traded is really valuable. If they trade at exchanges, they don't know who they traded with. But if they trade with retail clients, they know that they're trading with retail clients and they know why prices are moving quite often. And so that's an advantage to them. So what are the arguments for payment for order flow? The first argument is that wholesale dealers provide price improvement to retail traders. They give them better prices than they would receive at exchanges. But again, the prices that they might receive at exchanges could also include hidden orders. And the dealers don't provide price improvement in comparison to hidden orders. They provide price improvement in comparison to displayed orders. So if you believe that there's no hidden liquidity, it's a good thing that they're providing price improvement. But if there's hidden liquidity, then you wonder whether the customers are doing as well as they ought to be doing. These payments for order flow, it's argued, allow brokers to offer zero commission trades and provide other services to their clients. But payments to order flow and zero commissions, they're not linked. Both affect broker net income, as do many other revenues and costs. So there's a claim that they're linked, but in fact, there's no formal linkage. It simply provides brokers with more money. What they do with it is their business. There's also a competitive argument for payment for order flow. And the argument goes like this. The wholesale dealers compete to obtain retail order flow from the brokers. The way they compete is by offering higher payments and sometimes offering better prices to the customers. The effect of this competition is to erode any profits or excess profits that the wholesale dealers might make from obtaining these orders. Now, likewise, the retail brokers compete to obtain order flow from their customers. And they do this by offering lower commissions or more service. In perfect competition, they will compete away any benefits they get from payment from order flow by providing the customers these lower commissions and better services. Unfortunately, though, the brokers may also spend on advertising and marketing, which may not benefit the customer. So what are the arguments against payment for order flow? The first argument is, as much as we believe in competition, and we surely do, we know that the competition is not perfect. The dealers and brokers make money from the system, and we know that they make money from the system because they vociferously defend it. The fact that they defend it with such rigor and enthusiasm is prima facie evidence that they benefit from it. Another argument against payment for order flow is that if you believe that the payment for order flow is what's giving us the zero commission trades, and it certainly helps fund it, then you might be concerned about whether retail traders fully appreciate the costs of their trading. They're told that trading is zero commission, seemingly less expensive or no expense, but in fact, there are other expenses to trading, not least of which is buying at higher prices than the prices at which you sell. But when people think that their trading is free, they might do too much of it, and that's often not good for the trader and may not be good for the economy as a whole. Another argument against payment for order flow is that this standard of giving best execution, that price is no worse than the national best bidder offer, is sort of the wrong standard. The broker should be getting the best available price. The national best bidder offer is the best available price that's visible, but there are often prices that are better than that are hidden. And there are easy ways of finding them that brokers know well. So many people think that brokers should be responsible for searching for hidden liquidity instead of allowing the wholesale dealers to go and collect it for themselves after they've traded with the retail traders. So given concerns about payment for order flow, in particular that it might distort order routing decisions, it's natural to ask how we might address the problem. The first way to do it is to simply ban payment for order flow. Say that the dealers cannot pay for order flow. If you do that, what will happen is that there'll be an increase in internalization. And in the extreme, and it's not all that extreme, the wholesale dealers can internalize by simply buying the retail brokers, or vice versa. The brokers can buy the wholesalers, and by combining, they can then internalize, and you get effectively the same thing. So another alternative is to ban payment for order flow and also ban internalization. That would force the dealers to compete only on price. So if a broker is to send an order to a dealer, presumably the broker will only do it if the dealer offers a better price for the client. But exchange fee payment systems may also distort order routing decisions. We haven't talked about them, and that would be worthy of another entire talk. And so the fear here is if you ban payment for order flow and internalization, people may start sending to exchanges in ways that will disadvantage the client as well, because of the client perhaps should be getting better prices by allowing the dealers to discriminate in their favor because the retail clients tend to be less well informed. So the final alternative is to require that brokers pass all payments for order flow and all exchange fees through to their clients. If you did this, we would remove all broker conflicts. This is the alternative that I most favor. So in conclusion, here's a couple of observations. Banning internalization sounds like it's a radical policy, but it's not. It has precedence. The futures markets have always banned dual trading, which is just another name for internalization. Dual trading is a broker acting both as broker and dealer. The notion that best execution depends only on exposed exchange prices, that's an antiquated notion when hidden orders are common. So what we really need is to recognize that hidden orders are out there and brokers ought to be going out and getting them. So the way to do this is to get all payments for order flow to be passed through to the customers so that they don't corrupt brokers' decisions about how to route orders. Then brokers should be routing based on where they find the best prices, and the clients would be best served. Well, thank you very much for your attention, and that's it.